Alfonso Cajero, A Journey into Finance History. Chapter 65, Surge in Cryptocurrency Popularity and Valuation, 2020-2021. Digital currencies like Bitcoin reached all-time highs. In the vast expanse of the internet, amidst forums and obscure corners, a mysterious digital currency emerged from the shadows, captivating the imagination of millions around the world. It was the year 2009 when Satoshi Nakamoto, a pseudonymous figure shrouded in mystery, introduced Bitcoin to the world. Initially met with skepticism and curiosity, Bitcoin gradually gained traction among tech enthusiasts and early adopters. The genesis of Bitcoin marked a paradigm shift in the concept of money. It was not issued by any central authority, nor was it bound by geographical constraints. Instead, Bitcoin operated on a decentralized network where transactions were verified by a consensus of nodes. This revolutionary technology, known as blockchain, underpinned Bitcoin's operation, ensuring transparency, security, and immutability. As the first chapter in the saga of cryptocurrency unfolded, the world witnessed the birth of a new form of money, one that transcended borders and traditional financial systems. Bitcoin, often referred to as digital gold, held the promise of decentralization, security, and financial freedom. Its value was not derived from tangible assets, but from the trust and belief of its users, a concept that would come to redefine the very nature of wealth in the digital age. At the heart of Bitcoin's innovation lay the blockchain technology, a distributed ledger system that underpinned its operation. Unlike conventional financial institutions that relied on centralized authorities to validate transactions, blockchain offered a decentralized network where transactions were verified by a consensus of nodes. The Genesis block, mined by Nakamoto in January 2009, marked the beginning of an immutable chain of blocks, each containing a record of transactions. This groundbreaking technology laid the foundation for not only Bitcoin, but also a myriad of other cryptocurrencies and blockchain applications. Blockchain's potential extended far beyond the realm of digital currencies. Its decentralized and transparent nature made it suitable for a wide range of applications, including supply chain management, identity verification, and voting systems. The immutable nature of blockchain ensured that once data was recorded, it could not be altered or tampered with, providing unprecedented levels of security and trust. As the world began to grasp the transformative power of blockchain, entrepreneurs and innovators seized the opportunity to explore its potential. From finance to healthcare, from logistics to entertainment, blockchain promised to revolutionize industries and reshape the way we interact with the digital world. As Bitcoin continued to garner attention, developers and innovators began experimenting with alternative cryptocurrencies, or altcoins. Inspired by the success of Bitcoin, these digital assets introduced various features and improvements, aiming to address perceived limitations of the pioneer cryptocurrency. Litecoin, launched in 2011 by Charlie Lee, offered faster transaction times and lower fees compared to Bitcoin. Its script hashing algorithm differentiated it from Bitcoin's SHA-256, making it more accessible to individual miners. Despite initial skepticism, Litecoin gained traction among crypto enthusiasts, establishing itself as one of the leading altcoins in the market. Ethereum, introduced by Vitalik Buterin in 2015, revolutionized the landscape with its smart contract functionality. Unlike Bitcoin, which primarily served as a digital currency, Ethereum was designed as a platform for building decentralized applications, dApps. Smart contracts, self-executing contracts with the terms of the agreement directly written into code, enabled developers to create a wide range of applications, from decentralized finance, DeFi, to non-fungible tokens, NFTs. The rise of altcoins signaled a diversification of the cryptocurrency market, offering users a wider array of options beyond Bitcoin. While Bitcoin remained the dominant player, altcoins carved out their niches, each with its unique value proposition and community. Together, they formed a vibrant and dynamic ecosystem, driving innovation and pushing the boundaries of what was possible with blockchain technology. While cryptocurrencies promised anonymity and security, they also attracted illicit activities, most notably on the dark web marketplace known as the Silk Road. Founded by Ross Ulbricht in 2011, the Silk Road facilitated the anonymous exchange of goods and services, including illegal drugs, using Bitcoin as its primary currency. The rise of the Silk Road posed a challenge to law enforcement agencies around the world. Operating on the dark web, beyond the reach of traditional policing methods, the Silk Road represented a new frontier in the battle against online crime. Despite efforts to shut it down, the Silk Road continued to thrive, fueled by the anonymity and censorship resistance offered by Bitcoin. The saga of the Silk Road highlighted the complex relationship between cryptocurrencies, privacy, and regulation. While Bitcoin offered users unprecedented levels of financial sovereignty, it also provided a platform for illicit activities. Governments and regulators grappled with the challenge of balancing the need for privacy and innovation with the imperative to combat crime and protect public safety. The eventual takedown of the Silk Road by law enforcement authorities was a watershed moment in the history of Bitcoin. It demonstrated the ability of governments to intervene in the cryptocurrency space and enforce existing laws and regulations. However, it also raised questions about the limits of regulation and the potential for censorship in decentralized networks. By the mid-2010s, Bitcoin had transcended its niche origins and entered the mainstream consciousness. Major companies and institutions began to take notice, with some even accepting Bitcoin as a form of payment. This newfound recognition brought both legitimacy and volatility to the world of cryptocurrencies. As Bitcoin's price soared to new heights, fueled by media attention and speculative frenzy, it captured the imagination of investors around the world. The prospect of astronomical returns drew both seasoned traders and novices alike into the world of cryptocurrency investing. However, with great opportunity came great risk, as the volatile nature of the market led to both fortunes made and lost in the blink of an eye. The mainstream recognition of Bitcoin also brought with it increased scrutiny from regulators and policymakers. Concerns about money laundering, tax evasion, and market manipulation prompted governments to introduce stricter regulations on cryptocurrency exchanges and transactions. While some welcomed the oversight as a step towards legitimacy, others saw it as an encroachment on the principles of decentralization and financial freedom. Despite the challenges and controversies, Bitcoin continued to march towards mainstream adoption. Major financial institutions began to explore the potential of blockchain technology, with some even investing in cryptocurrencies as part of their asset portfolios. The once maligned digital currency had come a long way since its humble beginnings, paving the way for a new era of digital finance and innovation. As Bitcoin gained traction in the mainstream, another phenomenon captured the attention of the crypto community: the halving events. Programmed into the Bitcoin protocol, halving events occurred approximately every 4 years and involved cutting the block reward in half, reducing the rate at which new Bitcoins were created. The halving events were designed to ensure the scarcity of Bitcoin, mimicking the supply dynamics of precious metals like gold. With each halving, the rate of inflation decreased, making Bitcoin increasingly scarce over time. This deflationary model appealed to investors seeking a hedge against inflation and fiat currency depreciation. The first halving event occurred in November 2012, reducing the block reward from 50 Bitcoins to 25 Bitcoins per block. The event was met with anticipation and speculation, as traders and analysts debated its potential impact on Bitcoin's price. In the months that followed, Bitcoin experienced a bullish trend, reaching new all-time highs and solidifying its position as a viable asset class. In July 2016, further reducing the block reward to 12.5 Bitcoins per block. Once again, the halving event captured the attention of the cryptocurrency community, with many speculating on its potential effects on Bitcoin's price dynamics. In the months following the event, Bitcoin embarked on a remarkable bull run, surpassing previous all-time highs and attracting a wave of new investors and speculators. The third halving event, scheduled for May 2020, generated significant anticipation and excitement. As the date approached, Traders and analysts speculated on the potential impact of the halving on Bitcoin's price trajectory. Some predicted a sharp increase in demand as the supply of new Bitcoins dwindled, while others cautioned against excessive optimism, citing historical precedents and market dynamics. When the halving finally occurred, Bitcoin's block reward was reduced to 6.25 Bitcoins per block, further reinforcing its scarcity and store of value properties. In the weeks and months following the event, Bitcoin experienced a surge in price, surpassing previous all-time highs and reaching unprecedented levels of mainstream attention. The halving events underscored Bitcoin's unique monetary policy and its appeal as a hedge against inflation and economic uncertainty. By reducing the rate of new supply issuance, the halving events emphasized Bitcoin's deflationary nature, contrasting sharply with the inflationary policies of fiat currencies controlled by central banks.